Welcome to the deep dive. Today we're jumping into something that sounds, well, a bit like a puzzle, drawn from Mansi's Trading Tips 73.
Yeah, it's this idea about opinions in the stock market.
Exactly. We're going to unpack how two views that are completely opposite can actually both be right.
And just as interesting, how two opposing views can both turn out to be wrong.
Right. So the aim for this deep dive is really to, provide a clearer way to think about these dynamics, cut through some confusion.
It definitely seems counterintuitive at first, doesn't it? Like, how can that even work?
Hmm.
But when you look closely at the market, these aren't just thought experiments. They happen. And understanding them, it really helps clarify how markets behave and how we should maybe approach all the analysis out there.
Okay, so let's tackle the first one. This idea that two contrary opinions, say buy and sell on the same thing, can somehow both be correct. How does that work in practice?
Well, the key thing really is that being correct in the market isn't always absolute. It often depends heavily on the context.
Context like time frame.
Exactly. Time frame is a huge one. So imagine a specific stock. You might have one analyst looking at it, maybe thinking about the next few months.
Okay, short term.
Yeah. They see a new product coming. Maybe the general market mood is positive short term. So their analysis leads them to say, okay, this is a buy.
And if the stock goes up in those few months,
Then, yeah, based on their short-term view, they were right. The buy call worked out for that period.
makes sense.
But then you could have another analyst looking at the exact same stock at the exact same time.
Okay.
But their focus is, say, the next 5 years, much longer term.
Right.
And maybe they see, I don't know, rising competition down the road. Or maybe the whole industry is shifting in a way that's risky for this company long term.
So they're seeing potential problems further out.
Precisely. And their analysis might lead to a sell recommendation.
Yeah.
And if, over those 5 years, those risks do play out and the
Yeah.
stock underperforms or drops.
Then they were right too, just on a different time scale.
Exactly. So it's not necessarily a contradiction. It's more about different goals, different time horizons. A short-term trader's buy can be perfectly valid for them.
While a long-term investor's sell is just as valid for their strategy.
Precisely. You really have to understand the why behind the opinion. What assumptions are they making? What's their time frame? What are their goals? That's crucial.
Okay, that clears up the both right scenario quite a bit. It's about perspective and time. Now, what about the other side? Both being wrong. How does that happen?
Yeah, this one really highlights the sheer uncertainty that's always present in the market. Analysis helps, but the future is never guaranteed.
For sure.
So let's picture this. You have one analyst who's super bullish. They're predicting a massive market rally. Maybe they're looking at certain economic data points.
Focusing on the positives, maybe.
Could be. Or maybe misinterpreting something. So they're saying, buy everything, big boom coming.
Okay, the optimist?
Right. Then at the same time, you have another analyst who's extremely bearish. They're warning of a huge crash. Maybe they're like overreacting to some political news or seeing bubbles everywhere.
Pessimist, seeing danger signs?
Exactly. Advising everyone to sell. Get out.
Yeah.
So you have these two totally opposite extreme predictions.
Buy versus sell, boom versus crash.
Yeah. But what if neither happens? What if the economy just kind of muddles through moderate growth, no big boom, no sharp crash?
And the market just goes sideways. Or maybe up a little, down a little, but nothing dramatic.
Exactly. It just trades in a range for a while. In that case, the analyst predicting the huge boom, wrong.
Right.
And the analyst predicting the severe crash, also wrong.
So both extremes missed the actual outcome.
Completely. Because, well, markets are complex. Unexpected things happen, a geopolitical shock, a natural disaster, some tech disruption nobody saw coming.
Just stuff that just wasn't in either of their models.
Right. And predictions have limits. They're based on current info, assumptions, and sometimes those are just flawed or incomplete.
And I guess bias plays a role too, right? Like confirmation bias, where you only see data that fits your prediction.
Absolutely. Emotional biases, wishful thinking, fear, overconfidence. They can all lead analysts, both bullish and bearish ones, to make calls that just don't pan out. The market doesn't always follow the script.
Okay, so we have these two interesting possibilities. Contrary views can both be right, depending on context and time. And contrary views can both be totally wrong, because the market is, well, unpredictable.
Yeah.
So how do we sort of synthesize these? What's the practical takeaway for someone listening, trying to make sense of all the market noise?
I think the real value here is developing a more, let's say, nuanced way of thinking. a more critical eye.
How so?
Well, knowing that two opposite opinions can both be valid encourages you to look deeper than just the headline. Right?
Okay, yeah. Don't just take the buy or sell at face value.
Exactly. Ask why. What's their reasoning? What are they assuming? What time frame are they talking about? It forces you to engage more actively with the analysis.
Right, understand the argument behind it.
And then, knowing that both sides can also be wrong, that should probably instill a bit of healthy skepticism. And maybe some humility in our own views, too.
Yeah. Don't get too attached to any single prediction, even your own.
Precisely. Because forecasts are just forecasts. They're not guarantees. Recognizing this helps you avoid being swayed too easily by, the loudest voice or the most convincing sounding argument.
So it's about being more open-minded, maybe? Considering different possibilities instead of betting everything on one outcome.
I think that's a great way to put it. It encourages you to think in terms of scenarios, probabilities, to build investment approaches that are maybe a bit more robust, that can handle things not going exactly as predicted.
That makes a lot of sense. Okay, let's quickly recap then. We've looked at this idea from Mansi's Trading Tip 73, that in the stock market, it's entirely possible for two opposing opinions to both hold truth, usually because of differing contexts like time frames or goals.
And conversely, it's also entirely possible for those same opposing opinions to both be completely off the mark.
Right, often because of unforeseen events, flawed analysis, or just the inherent unpredictability of it all.
And putting those two ideas together, it really pushes us towards a more sophisticated understanding, less black and white thinking.
Definitely. Okay, so here's a final thought to chew on as we wrap up.
All right.
If you really take on board these dual possibilities that opposing views can both be right and opposing views can both be wrong, how might that change the way you consume market news? How you evaluate what the experts are saying? Or even how you approach formulating your own investment ideas? What new questions does that raise for you about financial forecasting itself and how we make decisions under uncertainty? Something to think about. Thanks for joining us for the deep dive.